Do you think investing is only for the rich and famous? That you need some secret Wall Street knowledge to build wealth? What if I told you that in the next 10 minutes, you could learn a strategy so simple, yet so powerful, it has the potential to grow your money more effectively than what most stock-picking gurus promise? Believe it or not, the secret to massive wealth over time isn't complicated at all. Welcome back to our channel, your guide on the path to financial independence. In this 15th episode of our 30-part series, we're cutting through the noise. We're going to show you exactly how to build a simple, powerful investment portfolio that actually works, without the headaches and without the gambling. Let's get started. Think of building a portfolio like building a house. You need a strong foundation and different materials that work together. In investing, these materials are your assets. The first and most famous is stocks, which are small ownership pieces of a company. They have the highest potential for growth over the long run. But what happens when the stock market gets shaky? That's where bonds come in. Think of bonds as a loan you give to a government or a company. They pay you interest and are generally safer than stocks. They are the stabilizer in your portfolio, the thing that keeps everything steady when the stock market feels like a roller coaster. Now, buying individual stocks is risky. A company can go bankrupt, right? So, how do you own stocks without all that risk? The answer is index funds. An index fund is a basket that holds hundreds or even thousands of stocks all at once. For example, a total stock market index fund lets you own a tiny piece of almost every public company in the country. You're not betting on one horse, you're betting on the entire race. This is the core of smart, simple investing. But the world is a big place. To truly diversify, you should also consider international funds. These funds invest in companies outside of your home country, giving you a piece of global growth. Finally, for those who want a little extra, there are REITs or real estate investment trusts. These let you invest in a collection of properties, like apartment buildings or shopping malls, without having to buy the physical buildings yourself. It's an optional slice of real estate for your portfolio. So, how do you mix these ingredients together? Let's look at some simple recipes. If you're a beginner and have a long time to invest, say 20 or 30 years, you can be more aggressive. A great starting point is the 80-20 portfolio. That means 80% of your money goes into a total stock market index fund and 20% goes into a bond index fund. It's simple, powerful, and captures broad market growth while having a safety net. What if you're a bit more cautious, or maybe closer to retirement? You might prefer a balanced portfolio. A classic example is the 60-40 split, 60% in stocks and 40% in bonds. This mix provides solid growth potential, but with much less volatility. When stocks go down, your larger bond holding helps cushion the fall. It's a time-tested strategy for steady, reliable growth. And for the young investors who are ready to take on more risk for potentially higher rewards, there's the aggressive portfolio. This could be 90% in stocks and just 10% in bonds. With decades ahead of you, you have time to recover from any market downturns. This high stock allocation maximizes your long-term growth potential. The key is to pick a mix that lets you sleep at night. There's no one perfect answer, only the one that's perfect for you. Now that you have the ingredients and the recipes, what are the rules of the kitchen? How do you make sure you don't burn your investment dinner? These rules are non-negotiable for long-term success. First, and most importantly, use low-cost index funds. High fees are like termites eating away at your financial house. A 1% fee might sound small, but over 30 years, it can devour nearly a third of your potential returns. It's a silent wealth killer. Always look for funds with expense ratios below 0.1% if you can. Second, avoid the temptation to pick individual stocks. I know, it sounds exciting to find the next big thing. But do you really have the time to research hundreds of companies, read their financial reports, and compete against professional analysts who do this all day? For most of us, the answer is no. Picking stocks is more like gambling than investing. Sticking with broad index funds is the proven path. Third, you need to rebalance. What does that mean? Let's say you started with an 80/20 portfolio. After a great year for stocks, your portfolio might now be 85% stocks and 15% bonds. To rebalance, you would sell some stocks and buy some bonds to get back to your original 80/20 target. This forces you to sell high and buy low, and it keeps your risk level in check. Doing this just once a year is all you need. And finally, the most important rule of all, stay consistent. Investing is not a get-rich-quick scheme. It's a marathon, not a sprint. You have to keep investing money regularly, whether the market is up or down. This is called dollar cost averaging, and it's your superpower. Automate your investments so the money comes out of your account every month without you even thinking about it. Then, just leave it alone. The worst mistakes are usually made when people panic during a market crash and sell everything. Stay the course. Let's look at a real-world example to see why this matters so much. Imagine two friends, Anna and Ben. Both decide to invest $5,000 every year for 25 years. Anna follows the simple strategy we've talked about. She puts her money into a low-cost total stock market index fund and a bond fund. She automates it and forgets it. Ben, on the other hand, thinks he can beat the market. He spends hours watching financial news, follows tips from online forums, and buys and sells individual stocks he thinks will be winners. He gets excited when one of his picks goes up, but he also panics and sells when another one drops. He also pays higher fees for all this trading. After 25 years, what do their results look like? Anna, with her simple, boring strategy, has seen her portfolio grow steadily. Historically, a portfolio like hers has averaged returns between 7 and 10% per year. After 25 years, her initial investment of $125,000 could have grown to over $350,000, or even more than $500,000, thanks to the magic of compound interest. And Ben, his journey was a roller coaster. He had some wins, but he also had big losses. The high fees from frequent trading ate into his profits. His emotional decisions caused him to buy high and sell low. After 25 years, his portfolio is worth significantly less than Anna's. He worked harder, stressed more, and ended up with less. He fell into the classic trap that so many new investors do. This isn't just a story. Study after study shows that the vast majority of professional money managers fail to beat simple index funds over the long term. If the pros can't do it, what makes us think we can? The lesson is crystal clear: simplicity wins. A simple, diversified, low-cost portfolio that you contribute to consistently is the most reliable way to build wealth. So, to wrap it all up, you don't need to be a genius. You just need a plan. Choose a simple asset mix of stocks and bonds using low-cost index funds. Automate your contributions so you invest consistently every single month. Rebalance once a year. And most importantly, stay invested for the long term and ignore the noise. That's it. That's the whole secret. Thank you so much for watching. If you found this helpful, give this video a like and subscribe for more practical financial tips. Let us know in the comments which simple portfolio you're thinking of starting with. We'll see you in the next video.